everybody. My name is Mathew Owens, and welcome to Masters of Real Estate. Today, we are going to talk with TJ Burns, now a full-time investor that just jumped ship from his corporate job into full-time real estate investing. Has been doing it for a while now, and now to the point where he's like, hey, he's going to focus full-time and do this. So exciting time. So thanks so much, TJ. I really appreciate you coming on. Can you give a little bit about your background and what you're focused on in real estate, and what made you jump ship and try to move forward with this full time? That's pretty awesome.
Yeah, thanks for having me, Matthew. I really appreciate it. I started learning about real estate back in 2017, right around the time that I started my job, really as a way to diversify, build wealth, and ultimately, live life on my own terms. I always wanted to be an entrepreneur. Took me about 3 years to get into it, though. I spent a lot of time learning, educating myself, putting in offers on deals, made a lot of mistakes, mostly through inaction. And then in 2020, bought my first single-family home down in Florida. It was a new construction build. We were going to build it and rent it out. And then during that, I started to dabble in a few other things. I got my real estate license to learn about transacting real estate, and I sold a few houses. I started doing the house hack thing locally, and then I met somebody through a chance encounter. I found their wallet on the street. They were doing small to mid-sized multifamily, raising a little bit of money, and I started investing as a limited partner, and did about a dozen of those deals. Really liked the concept, kept learning about it, and eventually grew to the point where I started to co-sponsor some of those deals, raise a little bit of money. Brings me up to today, raised a little bit over $5 million, have expanded into a few other asset classes, like in addition to multifamily, short-term rentals, private credit. The deeper I got into entrepreneurship, the more I loved it, and it just made working for somebody else that much harder, and I haven't really processed all the reasons, how to articulate why I left, but I know it's the right move, and you caught me at a good time because I just put my notice in, and I'll be going full time into this business.
That's awesome, man. I remember working at a CPA firm job in 2006. I was just bored out of my mind going, I can't do this anymore. It's tax and audit. It's not my personality. And after a while, you get beat up and you're like, hey, I know I can do more. I know I can push myself. And yeah, there's trials and tribulations along the way to be able to do that. But it's really interesting when you jump ship and it's on your shoulders now to make income. It's a little scary, and don't get me wrong, when 2008 hit, I was looking at the job market going, should I go back? What should I do? And you're going to go through those ups and downs and stuff like that. It's an emotional roller coaster in the beginning, 14-hour days type stuff. And at the same time, it's crazy empowering because now your learning curves like this. You're always taking in everything, trying to get better, and learning the business side of things is, I'd say, the harder part, honestly, than the other side, right? You may understand, debt and equity investments, and that's super cool because that's the true way to financial freedom. And, learning those things while you're working for someone else and gaining that knowledge along the way is a major, step forward and an unfair advantage to just start with that level of knowledge. But then now, if you're going out there and doing this for yourself, of course, the business side, the marketing, the sales, the accounting, the human resources and people, all that stuff is harder to predict, I'll say, than just doing a deal, right? You know what I mean? Or doing like 3 or 4, even multiple deals like you've done in the past, and you've set up systems and have different things in place. But it's really, that's more of the challenge, I think, than anything else, is the running of the business aspect of things. It's kind of surprising. I remember going back and going, I'm going to have all this time to go to the gym all the time, and it's going to be no problem. And then you're going, oh my God, I got to work like crazy. So, you're going to have your work cut out for you, but I'm also super excited for you because now you have all this free time to focus 100% on education and deal flow and building this portfolio for yourself. So it's an exciting time, man.
Thank you. Yeah, I'm extremely excited. Everything you said resonates with me. It's been a lot of work up until this point, and in the business of, when you're syndicating deals, a lot of the times you're not making much money as you're doing a whole lot of work and taking on a lot of responsibility for years, right? And now in the market we're in too, where there aren't many exits, it rings even more true. But it's it's a great long-term business, and I think if I had to articulate why I left, I think it would be like just the human need for growth. Like you need to feel like you're growing in what you're doing, right? And
Right.
for me, where I was at, I felt like the possibility to grow was immense in this business, right? It's limitless basically, and it's just I just can't I can't not do it. Like I have to go for it.
Right, right, and I think what you bring up is really key, right? Having that initial bandwidth, that underlying, I'll say, capital from a job or consistent source of income, gives you that flexibility to go into like multifamily or other asset classes or properties that normally in the beginning for the operator or capital partners and things like that, there's not a lot of cash flow in the very beginning and a lot of ways to keep the lights on for yourself. You might have an asset under management fee or something like that, but a lot of times that ramps up over a period of time, or it's much more heavily weighted from an income standpoint on the back end because you want to have performance-based incentives in place and your investors should get paid first, right? So this is a hard part for a lot of operators in this space where they don't make a lot in the front. And so, that's one of the things that I like investing in. I know you do as well, to kind of counterbalance that is the debt side of things and the debt investments. And through those debt investments, you can create consistent cash flow streams for your investors as well as you as the operator of those deals too, and make cash flow consistency happen through that, which I think I really believe in from an investment perspective myself. I have wealth building long term, not as much cash flow, maybe some, and then after a couple of years it ramps up. As far as wealth building effects of owning property, and then on the debt side, having another separate strategy to cover all your monthly expenses with cash flow. So you get that, I'll say corporate job feel of having a paycheck coming in, So, and I think there's an important piece to anybody's portfolio like that. What drove you towards debt in the first place and made you interested in that piece of it from an investment vehicle standpoint?
Yeah, a couple of things, including what you just said. So, from looking at the macro perspective of what's going on in the economy right now, of course everybody knows that rates have gone up, right? And with that, the yields on the debt side have increased, and now a debt investment that maybe wasn't so attractive a few years ago is now yielding enough where it is attractive, right? So that's one part of it. The second part has to do with the lenders themselves and the banks, right? So people might be aware that there's a lot of stress in the banking system right now. Banks went out, they made loans to different groups, in order to generate yield. Maybe they originated mortgages, maybe they lent to other real estate assets, and now the value of those assets has dropped, right? And on paper, the banks are in a position where they have a lot of paper losses, and in response, they don't want to write any more business. They don't want to make any more loans in that sector. They're already overextended. And what that's done is it's created a bit of a vacuum in the lending space. Now there are less providers of capital, and it makes way for new providers to come in and dictate terms and have better borrowers to lend to, right? So there's those two things. From the standpoint you said, in terms of being the operator and being an entrepreneur, the cash flows are steadier. You can build a business around being a lender.
Right.
It's much easier to predict cash flows versus doing a multifamily deal, especially if you're raising money and you're giving preference to your investors. And then just like in terms of the capital stack and the fact that lending, with all other things equal, being lower in the capital stack and more towards the position of the debt, it's safer, right? You have a margin of safety in the loans
Right.
you're making. The equity acts as your cushion, right? So, in my role where I focus a lot on, working with investors, raising capital, I sleep a little bit better at night when I'm raising debt because I know that there is a bit of cushion there.
Yeah, I agree 100%. When I'm looking at, an equity play on a real estate deal, you're adding value. You're forcing that appreciation up in those situations to get a big chunk of equity coming in, and that's the primary play with a lot of real estate deals. In addition to the cash flow piece of it, right? And there's some operational expertise that has to go into that to be able to do that. And the debt side of things, you have that equity cushion because the operator is going to be putting that money down as a down payment, on that asset to protect you. And now they have a vested interest too to making sure you get paid. And so, you're even put in first position over even their investors in that situation, right? The thing that people don't understand is even though there's operational expertise that has to happen over here on the property side and the implementation of that asset, there's a massive amount of operational expertise that needs to go into the lending side, which also includes the operational expertise on the property side. Because if you don't know the borrower's operational capabilities, you can't assess the risk correctly. And it's interesting because there's so much that goes into some of the back end of doing due diligence on a note investment or being a lender, that it's a really good idea to have a full-time operator involved in that process. So many smaller investors come in and they want to be a private lender to one single fix and flipper, and sometimes it works out great, but other times they're not sophisticated enough to know what homework to do. So having that one operator in place is massively important for their protection, so that they can do that. Can you talk a little bit about the due diligence aspects of a note investment that you're looking at when you are assessing one of those deals to invest in, whether that's a fix and flip deal or a commercial deal that you work on?
Yeah, it's a great point. Just because you're investing in debt doesn't mean there's no risk, and it really depends upon, how you're underwriting it and who the borrower is and what the market
Right.
is. So, given that, one of the things that I govern my business with is realizing that there are a lot of people in real estate who have been doing this a long time, right? Yourself included, and they have a lot of knowledge. And what I'd rather do is I'd go rather work with them and bring them some sort of value,
Right.
and then leverage their expertise rather than me trying to go figure it out on my own and acting like I know everything, because I know I
Right.
don't, right? So that's a big part of it for me is going and working with people that have a lot of experience in doing what we're trying to do, usually teams of people that have different, come from different sectors. For instance, the fund that I'm working with now on the debt side, it's made up of people that have 20, 30 years of experience each. There's one person who's an expert in the legal aspect of things. There's one that is an expert in the lending side of things. There's one person that's an expert at running businesses and managing funds. Specifically with lending, I think a lot of the risk comes in the underwriting of the property. Like, put in layman's terms, we have to really understand how much this property is worth to us
Right.
before we can understand how much risk there is. And if you miss on that, like let's say you have a property that you think it's worth $1 million, but it turns out it's really worth $500,000. There goes your margin of safety, right?
Right.
So,
Right.
having local knowledge of wherever you're lending, whether that means working with local brokers, having boots on the ground there, or owning buildings in the area, that's a huge part of it. I think when thinking about lending, you have to think about the worst case scenario. So what happens if this note becomes non-performing and we're going to have to foreclose? There's
Right.
there's a
Right.
lot of regions where it's difficult to foreclose, right? And it might take could take years potentially, depending on where you're at. So the structure of those is important. And then, like, I think there's concentration risk too. You mentioned somebody that might have the great idea of saying, hey, I live in this area and I'm going to go lend on the single family house across the street because I understand the market. And I guess the borrower is another part of this whole thing that we can talk about, and assessing them and underwriting them. But if you're concentrated, if you're just making one lending to one property, there's maybe a bit more risk there than if you're doing a portfolio of properties, right?
Right.
So, yeah,
Yeah,
I'll
I
stop there.
I agree. I think the pooling of funds together really massively decreases the risk, right? Because like in our fund, we'd have to have a 25% default rate in order to start even affecting the investor's preferred returns, right? Because
Right.
of the pooled approach of this as well, it makes it a lot safer. We do accounts receivable financing, and it's all based on percentages of collections versus our cost to look at the collateralized value and stuff like that associated with this, or the collectible value of those accounts, and and we make interest off of those funds as well, and it's just a lot of that is assessing the risk in different ways and pooling things together. Any one deal can go bad, and so and usually, hopefully, it's a small percentage of the deals that go bad, if any, and because there's problems that occur in people's lives, and I think as a lender, you have to know how to stick and move. Also, when a problem occurs, what are your tools in your tool belt that you can come out with when something like that happens? Can you sell the note and make it someone else's problem so you don't have to worry about it, and you can redeploy capital and make interest rates on your interest on your money immediately again? Or can does it make sense to have someone on your team then that is an expert at taking over assets and redeploy and reselling them on the back end of the side, because there's a lot of profit margin in some of those deals, but you need to have the right team that can come in and be like, boom, let's take over that asset. And that's hard if you're lending in multiple markets around the country, takes multiple team members. And just like you said, like the attorney that's a specialist, and the person that runs a business, and the person that specializes in the lending side as well, and the underwriting, all those team members are everything to every business, and so you have to have the right team, or the whole system's going to break down. And one bad team member can really destroy an operation, or at least add a lot of risk to that business. And so when you're building these teams and you're working with these people, what are the different things you look for when you're working with them? Because if you're working with different operators and stuff, what are you looking at when you're trying to assess, hey, these guys are good people to work with, or let me wait, and see how they do?
Yeah, it's a really good question. Basically, how do you assess if I guess there's two components to it to me. It's one, do you know what you're doing? Like, that's kind of like a fundamental question that you're asking the person.
Right.
Do you know
Right.
what you're doing? Do you have expertise here? And how do I gauge that? And then the second thing is, kind of like, will you do right by me? Will you? You might know what you're doing, but are you going to be a bad actor? Are you going to, act in good faith with me? Are we going to be partners? The second one is surely, it's a little bit harder to gauge, right? And I think it comes for me through building a network within real estate and having now a lot of these mutual connections with people, like, all these different people that I met from different areas, and now I find out that they're connected to each other in some way.
Right.
And they're vouching for each other. They'll say, hey, I've done business with Matthew, and he's a good guy, and here's a sticky situation we had, and here's what he did, and I'll never forget that, right?
Yeah.
So that stuff, and especially references from people that I hold in high regard that have done great things in the industry, is all super important. And then there's all the regular logistical stuff like background checks and checking their history, and then I guess the first point of do you know what you're doing? I think a lot of it comes from experience, going back to what I said about working with people that have great track records, that have experience in doing exactly what we're trying to do here. And that part's a little tricky sometimes too, because let's say you're an expert in lending in like Alabama or something, right? That's great, but if we're running a fund in California, right, like it might be a little bit different.
Right.
There's a lot of stuff
legalities.
some stuff might carry over, but what I look for is people that have direct experience in doing exactly what we're trying to do, and
I think you hit the two things on the head, right away. Is at first, assessing their skill sets as best you can and understanding of the market. And like you said, someone may be specializing in a little bit different of an aspect, or even a different asset class or something like that. And how is that going to translate into what they're doing right now specifically? That's an important factor I think a lot of people overlook, even in COO level positions and, different, asset management positions and things like that, right? On the other side of things, the ethics piece is a tough one, because the best criminals feel like your best friend. You know what I mean? And so I've been duped so many times from people and stolen from so many times from people. And honestly, after running a property management company and a lending company, you're like, yeah, I don't trust anybody anymore. They're all criminals, you know? So after a while, it's like, hey, okay, let me do the background checks and do those assessments like you were talking about when you're asking other people for their opinions and what experience they've specifically had, what occurred in in previous investments that they're dealing that showed them that that person is an ethical person that is going to do the right thing by investors' capital and make sure they're protected at all costs, even above their own money, to make sure that they are able to perform correctly and be ethical, right? And I think even I invested with somebody for like the longest time, 20-year seasoned person. I was investing with them for like 7 years. All of a sudden, they decided to go and take the excess reserves and go lend it out randomly to different businesses without all the right paperwork in place and things like that. And they're in jail now, but you just stole the money after being a successful entrepreneur for 20 years and killing it. And maybe something crazy happened in their life, who knows? But there's things that happen with people, and so being able to protect yourself by doing the business with the right people, but also possibly diversifying into different asset classes, different markets of the country, and different operators. So if that one operator, goes out on you or doesn't perform on you, you're able to not be stressed out that all your money is in one basket like that as well, So I think there's mitigating factors in the initial due diligence, but also mitigating factors in the investment strategy as a whole that you can implement on that side. So, and I know you like doing both the equity and the debt side of things. What are the specific types of debt and types of equity that you like to focus on?
Yeah, I mean, if you don't mind, I'd love to just go back to what you just said real quick because I
Oh
thought
yeah,
it was
cool.
awesome. And really important points. I just wanted to highlight them. Like one, diversification, right? Like the reason we diversify is because we don't know what the future looks like, right? And um, a lot of people don't diversify. Like I come from the tech industry, and I saw a post today about somebody talking about NVIDIA, which is on a huge run right now. Um, and there are a lot of employees out there who are holding their NVIDIA stock. They got a couple $1 million in stock, and they think it's just going to keep going up, and all these stories end the same. It might, but it's also a really good idea to take that money and diversify it, because you just don't know what's going to happen, right? And it applies to everything, and to your point, if you're an LP out there, you should go and meet with a lot of different operators. You should invest in a lot of different things. You should have exposure to multifamily, to private credit, across all different markets. Um, so yeah, I'm glad you brought that up. And then the second thing was just incentives, right? Like, someone might be a good person, and things sometimes are gray, and things might change, and there might be instances where you want to just make sure that person's incentivized to do right by you, and the way that you set up these deals is super important for that reason. You want to make sure that the person you're investing with is making money when you make money, and
Right.
not just collecting fees without you making any money, or maybe I think right now a lot that's happening is people are just walking away from buildings because there's no more incentive for them. So incentives, diversification, like both huge points, and I'm glad you brought them up.
Yeah, I think I think the incentive piece is key. So many funds are structured without a preferred return or something like that in there, and I personally won't invest in those types of funds. I don't think it's a smart move to do that. You want to have I don't want to have the operator making money after even they already get an asset management fee, right, to be able to basically cover the work involved. That's what the asset management fee is supposed to be for, the cost and the work for doing it. And then the profit should be aligned with the operator or with the investors. And I don't want to sit there and get a 2% return on my money and then have the operator still making a split of that. So it's even worse. And that's really why you want that incentive for performance, so that way they're not, hey, just on to the next deal and on to the next deal. Like, I don't really care about the operations too much and blowing stuff up, because they're making a bunch of money, but their investors aren't. It's just the wrong incentive in place to not have that, outlined. And so I always invest in those types of preferred return type structures involved. And it's easy to do on the debt side. The investors get the first percentage, and then the operators get the rest. Sometimes you might have an asset management fee also if you're running a big fund or something like that, and then doing a split with the operators after, or with the investors after a preferred return as well. So there's all different types of structures, of course, out there that you can deal with. So what do you see most out there with some of these structures on the I'll say the lending side and then the asset side, as far as structures go?
Yeah, I mean, from what I've done, there's been, like you said, a preferred return. Try to minimize fees in the front end. Of course, you want your operator to be able to keep the lights on. You don't want them to be struggling, and that's a piece of it too. In that, if you invest with people that are already financially stable, you get a different experience perhaps than somebody that needs to get this done. I'm not saying if it's better or worse. Sometimes it's good to have a lot of incentive to make sure that you're putting food on the table.
Right.
But my approach has been become financially stable through my job, through investing, and then leave that and go off into the more risky entrepreneurship stuff, right? But yeah, like you said, structures are different. I've always invested or created funds or opportunities with preferred returns, with minimum fees in the front, and then some sort of promote structure on the back end. And then with debt funds, sometimes it's just the preferred return. And I found with investors, simple is better, right? So if you can simplify that for them as much as possible, they really appreciate that.
I call it the be the bank program is what I call it. It makes it simplified in people's mind that, hey, they're owning mortgages against people's houses, right? So, and I really enjoy the lending business. At the same time, I don't necessarily enjoy dealing with the transactional aspect of the lending business in itself, because there's so much servicing that happens after the fact. There's so much due diligence and underwriting that happens in the very beginning, appraisals, closings, back and forth. Sometimes they don't have the cash to close, or a deal blows up. I'd say 50% of the deals that get submitted through our pipeline, get rejected, or something happens where they don't close. It's not always a rejection. It's, a lot of times they're way off on market values. They don't have rehab bids detailed in. There's a lot of little factors that can go into problems there. And so you end up doing a lot of work to be able to get one loan. You might be doing the work of 2 or 3 loans sometimes to get that one loan done, because you got to be really strategic on what you invest in and who you invest with, right? So not every borrower has the right experience. Sometimes they've never done a deal, and that's a tough risk, because we all know the problems that can come with like doing a renovation, there's a million things that can go wrong, let alone the contractor and themselves, So there's a lot of risk that goes into that. Are you having to deal with that side, or do you have teams that are set up to do that? Because that's what I love about the lending, is that you can have the system with the right teams, and there's people out there, vendors out there in these different spots that you're an outsource to do that.
Mm-hmm. Yeah, I don't deal with any of that, honestly. And like you said, there's a lot that goes into it, and that is the business part, right? That's building the business, and that's why you're getting paid what you do, in creating a fund, right? So my role specifically is I work with a lot of funds that have a high minimum, So very simple, they might have a minimum of $250,000, $500,000, and what I'll do is I'll create an SPV, a special purpose vehicle, that can invest into their offering. I'll do due diligence on their fund. I'll build a relationship with them. I'll do all that part, and then I can go raise money from retail investors, right? So in that way, I don't participate in the nitty gritty of the business, which
right.
I'm thankful for, because, like you said, there's a lot that goes into it. It can be
hard.
A grind,
a lot of work,
a lot of paperwork, a lot of back and forth. And instead my approach is just to go find those people that are killing it and bring them value in some way.
And I think that's a very good strategy. A lot of people think that they need their own money to invest in real estate, and they really don't need their own capital. Yeah, it helps to put some capital in yourself and show your investors you believe in this stuff too, and what you're doing, and put your money where your mouth is on that stuff if you have the capital to do so. At the same time, being able to go through and raise, say, $1 million for a deal out of a $5 million raise, most operators are going to give you a little bit better metrics on that deal. So that way your investors can make the same as if they invested directly, or even a little better. And that helps you as the coordinator of the compiler of capital bring in an extra $1 million to the table to make some spread on that income, and help also when, if something goes wrong, being able to step in and say, hey operator, what's going on here, let me give the information to report back to my investors, and help handle issues if something's coming up. You have another layer of an asset manager in place that can help from that perspective, along with a lot of times the investors getting a little bit better deal metrics than just going in individually themselves, right? So there can be really, really cool strategies to implement that way, and you can build wealth just by knowing who to invest with and how to do the homework with them and how to do the right asset management. Very similar to what you're talking about with the, I'll call it fund to funds or limited partnership structure, where you're able to raise more capital for those structures. So really cool, man. So, well, and so if people want to get a hold of you, how do they get a hold of you, man? And what and how do you help investors out?
I'm pretty active on LinkedIn. I try to post a
Okay.
couple times a week, give advice to LPs, and just talk about what I'm doing. So if you'd like, connect with me there, TJ Burns on LinkedIn. And if you find me there, that'll take you to my website, burnscapital.co. Those are the best spots to reach me.
Awesome. And if anybody needs to get a hold of us, you can go to MathewOwens.com with one T in Matthew. And we actually have a 200-point due diligence checklist on our website you guys can download that we utilize when we're analyzing investments to invest in. We have quick analysis sheets. We have master classes and different courses on there you guys can have for free as well. So feel free to go ahead and reach out anytime you guys want for any free information. So thanks so much, TJ. Really appreciate the time today. And we'll have to definitely talk about some of your deals in the future. That's the whole point of real estate, is how do we help each other make money? So I'd love to see the deal flow that you got coming in.
Right on. Thanks for having me.
Thanks, man. Talk to you soon. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.